let's start then. You saw the numbers today. Bobby and I have been having this argument. I thought they were going to start easing a long time ago. And because of that, I was long stocks, long gold, long Bitcoin, long silver. I've been dead ass wrong and still made quite a bit of money, which I'd rather be right and make money, but the money's the most important part. What is this number today? Is this a sign that it's reigniting?
But it already was there. I mean, how they camouflage is really, you can see bonds, right? Just study bonds. Take a look at gold spiking higher, on March 1st. And in fact, when it did that, I had a big long post, right? I have a Substack where I said, that's it. The crash up call in NASDAQ is off. And it really, really was off. We've only gone sideways, right? So we've literally gone nowhere fast since March 1st when gold started pushing higher. Then silver went in wonderful squeeze. So that's very, very much a warning that stocks are overvalued. It's also a warning that bonds are overvalued. So the fact that they're both falling together today, maybe not as much as you would like, but underneath the surface, the breadth has broken down and net selling has picked up. That's something that I watch very closely. And it really hadn't until just recently. So this gold spike was absolutely the tell, and why I literally penned this post. It's time for NASDAQ to slow the F down, and it has.
So Samantha, Jimmy and I will both tell you that I'll go me first. I get a fundamental view, and then I look at the charts to see when a good idea is to enter that particular fundamental view, or even sometimes the chart tells me that it's a bad idea, and I just don't do it. It seems to me it's a long way down before the indices are in trouble, so to speak. So is this another one of those, and I don't mean today or even the data, but is this another one of those blips where it's just going to go back to support somewhere, say, I don't know, S&P maybe around 5140, something like that, and then bounce back up? Or you think this could be protracted?
All right. So let me back up before I give you my next call, right?
Yeah.
So in mid-November, I wasn't really sure what we were going to get in this short covering rally from the November 1st kind of, Fed pause and what I call Yellen Yahtzee, where Yellen issued more, short duration T-bills and longer duration notes and bonds. And that was just an absolute have at it. We're going crazy with the FOMO and AI. Now, fast forward to January, before FOMC, I doubled down. I said, I'm very bullish. I actually think this is going to broaden out. It isn't like the 1999-esque rally, which semis were already underway, right? I really, really thought we were going to broaden out. So I did Bloomberg, I did Market Watch, and I'm like, I like the IPOs, I like the retail oversold left for dead, I like the small caps, I like biotech. And we positioned and we did a really great job. And then March 1st, gold went crazy. And that was my tell that it was absolutely, literally the pen. It's NASDAQ. It's time that my crash up call is being pulled back. We're done. And at the time in mid-January, I had given very specific levels in SPX. It was 5340. And I gave the Qs, NASDAQ 100, 444. We did hit the 444. We did not hit 5340. And then I penned most recently 5340 or bust. I think we get bust. I think we're done. So I actually, now that we've had not just the inflation, but the whole fiscal dominance. I mean, Biden out today talking about, we're going to have a rate cut by the end of the year because I said so. Trump's going to use that because Trump said that. Yellen issuing at the end of this month, the QRA, the quarterly refunding announcement. If she goes short duration, it's going to look very political. If they cut in June, it's going to look very political. This backdrop of fiscal dominance is no joke. And most are still using a lens of monetary dominance. So they're looking at monetary policy actually having control. Forget about it. Fed has lost really the plot. And Yellen going, to China, probably, hey, buddy, can you buy some bonds? And then seriously, Biden today is hosting the Prime Minister of Japan. Hey, buddy, can you buy some bonds? No, treasuries are absolutely in trouble. Bonds are the tell. So my call right now is bond bulls need to defend here. So a few days ago, I actually wrote this post about FX and bond intervention. We need it right now. Otherwise, the equities are going to go over.
So when you say we're done, are you talking about like
the highs for the year?
Okay, highs for the year. So
the highs for the year.
I mean,
So,
like I look at the SPX, and to get back to the July 2023 highs, for example, right, which was kind of the rotational highs before we bottomed and then made this second move, that's about 12.5% away. That would worry people. Is that too big of a move in your opinion, or no?
what do you, too big to go what, up or down?
Like if we went down 12.5% and sort of held at the last year's highs, it's like July 2023 where you get those numbers. I don't know what the level is, 4,800, maybe somewhere around there. Would that be too big of a move based on what you're saying we're done, or you're just saying there's not going to be any more highs?
I think that without intervention, market is overbought. Okay. Now, I had been saying for several months, my line was market is overbought but not broken. So I said that in December. I said that in January. I said that in February. March 1st, when gold took off like a rocket and then silver followed, I said, nope. I'm not even going to get my 53.40. I think we're done unless we get intervention.
Okay, so intervention. When you say intervention, because yesterday the Fed bought $1 billion, whatever. I can't remember what duration. Today they announced that they're cutting in half the amount they're letting rolling off. Did you guys see that headline today?
Yeah, that was
just hold on Bloomberg real quick. So when you're saying intervention, are you talking about the Fed reinstituting buying bonds?
I'm talking about whatever underneath the surface or on top that keeps rates from spiking higher. So this right now, bond support needs to come into play, or else yields are going to continue spiking higher. Dollar has already spiked higher, but remember, there's dollar as it relates to other currencies. It's very strong. Then there's dollar as it relates to hard commodities. It's very weak.
We talk about that all the time. Yes,
exactly. Right. So this is really, really, really important. So the dollar is, I made this call also back in November that the US dollar has likely peaked. So relatively speaking, yes, we know about it relative to other FX, but now with China doing so much more of its, out of the FX reserves regime of, the petrodollar and such, it's slow but sure. With their focus on EV, again, to remove themselves from the petrodollar, there is more and more brick action. It's not an overnight thing, and it's also not a bad thing, big picture for us. But for right now, it is very disruptive to the Treasury market. And the Treasury market is the largest market that must be defended, bar none. So the fact that we have yields spiking higher with dollar, with gold and silver, we have stocks selling off with bonds. Stocks right now have the advantage of massive market structure and options to protect them, unless we trigger some very key levels in what's called negative gamma. We're already there. 52.26 is a negative gamma level of mine. We stay below there. We pick up a little bit more selling because dealers have to sell weakness. Then you get the carry-on effect, literally, of the vol control funds. And then you also have the price insensitive CTA funds, which are really balls to the wall, 156 billion at the 100th percentile long equities. In a down tape, they have to sell 141 billion in a period during earnings where there's a blackout for buybacks. So my point is there's more energy right now for something to happen. And this is the first time in months that we've actually had ingredients underneath the surface where we could actually get more than just volatility for, a week. We could actually have some follow through. So I think if the intervention comes in, which means we already saw some of it today, like you just said, right? After that terrible 10-year auction, if we have Japan, on the doorstep of Biden White House visit, on the doorstep of Biden also saying, yeah, we're going to have a cut by the end of the year. What's next? Will we hear from SNB? There'll be something that will come in to intervene, to tap down dollar and yields. That's my baseline bet.
Okay, that's interesting. So we've had you're pretty high in economists on too, and some have suggested that the Fed is comfortable with a steeper yield curve, just not going to get too steep. I mean, they may let 10-year yields go higher. And I actually, on some level, agree with that. I don't think they start to panic till over 5.5%. Do you think that sounds reasonable?
They already panicked at 5. Risk premium was really, really positive right now. Before today, I haven't looked honestly today, but when Yellen went and did her November 1st Yellen Yahtzee, premium was very positive. So she could, stuff a lot of bills onto the market. Very hard to do if we're in negative term premia. So I think a lot of that's going to depend right there. And I didn't check today, but I'm very hesitant that the market has accepted higher than 5%. I think she already came in very strongly with, by the way, Bank of Japan and Fed all on that November 1st timeframe to tap down dollar and yields. Now that they're percolating back up again, I think there's going to be some type of coordinated effort to try and stop that activity right before an election, and oil too. So those are kind of the intervention collars that I look for in order to stay long risk. Like I have a trend long portfolio. I have swings that are mostly longs, but now I'm starting to rotate and put some shorts in there, right? So it's a transitional period right now, but I'm not bullish like I was in January, like I was in mid-November.
So we had a market last year, Samantha, that like say the last half of last year that was being driven by, I don't know, one stock. Maybe it was 7 stocks. It was a very narrow rally, right? And there was a lot of talk about how the rally needed to broaden. And then it broadened. And now when I see things like, not related to stocks, when I see things like the Small Business Optimism Index yesterday, go from, what was it, 88, it went from like 89.4 to like 88.5. We're sub-recessionary levels. Do you think that the weakness will broaden to those Magnificent 7 rather than those Magnificent 7 started to bring the small caps back up? Is that the transition we're going to see?
So it was funny. I really was bullish in mid-February for this everything rally. I wrote about it. I talked about it. No, I'm not right now. This was too dramatic from March 1st with the gold and silver extravaganza, which is a real big warning in silver, and they're not done. My gold silver ratio is the most bullish chart I have. To
bullish for silver, right?
Both. I mean,
both
silver has
okay.
Lots of room to catch up.
That's what I thought too. Okay, good.
Yeah. It's a gold silver ratio. So the treasury dump, the auctions, the failed auctions, the higher oil with entrenched inflation. I'm a big inflationista, so this is not a surprise to me. Long story short, I think it's going to be a lot harder. Where is that wall of worry to climb when we know the Fed really can't hike and they really can't cut, right? So they're going to be in wait mode. Will we really get a surprise again from NVIDIA? Because obviously, if they sell NVIDIA, why buy anything else? We definitely. I mean, I'm swing long Amazon. I'm definitely still exposed in longs, both tech, I should say growth and value, but I absolutely don't feel good about it anymore. And I did up until March.
So tell me this. So swing to Japan real quick. Because by the way, you mentioned something that we talk about all the time. This nonsense that the dollar's strong because you can buy a lot of yen with it is the most asinine thing I've ever heard. Go buy a bag of groceries and they'll tell you how strong your dollar is. Okay, so today, Japan, 2 weeks ago, 3 weeks ago, they go into positive rates for the first time in 8 years. What happens? The yen gets absolutely caned. Today, again, the yen gets pummeled. Are they going to be in a position that they can, be selling yen to buy dollars, to buy treasuries?
No. So that's why I think they're here. And this is absolutely the problem because inflation has definitely reared its head over there, wage inflation and such. The market has been doing really phenomenally well. They have promised, they have threatened, however you want to look at the officials, MOF, in Japan and such, to tap down that 152 level. So they're not going to let the yen, fall, except as it relates. In other words, it will devalue against the dollar. They're okay with that. But that's the race that's on, right? But I don't think that this is going to be easy for them to step in and kind of help us like they did, for example, October 21st in 2022. And again, in October of 2023, October and November of 2023, they're in a little bit different predicament. And there's a lot of, FX Asian currency deval that's underway relative to the dollar that makes it even harder for them. I don't think it's a coincidence that the Prime Minister of Japan was here on the same day that we had this massive hot CPI print. That's me.
Okay, so it sounds to me, just by shake your head before I finish the question, you're saying that we're kind of effed, right? We're in a very difficult spot. Okay, so I agree with that too, by the way, and that's one of the things that's fueled my trading and my positioning over the last year. And if you have to look at like 5 things, well, first of all, how long is this effedness going to last? Is this a 5-year thing before we can work our way out of it? Is the government ever going to actually impose some level of austerity on themselves so we don't have to be flooding the world with treasuries that people don't really want that much? And if so, what do you buy? What do you buy in that time?
Okay, so I can't do the 5-year thing. That's way not my bailiwick. I can see that we have strength. In other words, recession has been delayed because wage inflation has been strong enough to outpace inflation. Now that might change now, but for right now, Fed's not going to cut really until unemployment gets above CPI. And right now they're neck and neck. So we still have a backdrop of strength in the economy from a labor standpoint, from wage inflation, which also helps with consumption demand, company profit margins, all that stuff. It hasn't hit banks yet, which, by the way, makes it really hard for the Fed because they really are damned if they do and damned if they don't when it comes to the banks. So we haven't had the deterioration in banks, but there's definitely softening. I'm very blessed that I have 2 macro advisors for our Edge product, and one is very in the weeds on FDIC reviews. And he's like, NIMs are starting to shrink. Loans are starting to tighten. There's actually signs of stress that the market doesn't see yet. So banks right now are starting to roll over underneath the surface. Consumers, yes, they're stressed, but because wage inflation, recession has been delayed. We haven't had that employment surge of payroll claims and such. So that, and of course, they're still spending like a drunken sailor over there in Congress. So fiscal spending nominally is pushing this GDP along, but with diminishing rate of returns. The higher the interest rate, right, the more they have to spend even to move the needle. This is a fool's, last one buys, whatever. So no, I'm definitely looking at this going, we had a backdrop where it was at least through the election, they're not going to let the bond market fail. They're not going to let the equity market fail. The economy will lag. Housing market, I'm actually a big housing bull. I actually think I've made a warm summer housing call, which means I think we're going to start to see movement in there. Even though rates are very high right now, because I believe intervention will kick in, wouldn't be surprised if MOVE, the Treasury Index, softens 30 years. Actually, we got a 30-year Treasury auction tomorrow. Start to soften. They want that. They need that. They need this housing market to open up and be strong into the election. So I'm thinking about motivations more so than just looking at the data. I'm looking at the motivations of the players and where they need us to be into November.
So Samantha, one of the things I've always liked about your work that I see on X anyway is that you're really good at not saying what they should do, more saying what you think they'll do and what the effect might be. Do you have an opinion on what they should do? Because what drives me crazy is they have this dual mandate and they're clearly much more focused on unemployment in the stock market than they are inflation, in my view. But again, as a strategist, my job is not to decide what they should do. I don't think they should cut rates, but I think they will. Do you have a thought either way as to what they should do versus what they will?
Yeah, stop spending like drunken sailors. I think that's the only way this is going to get fixed. Full stop. Full stop. Full stop. They should never have suppressed price discovery and yields. They should have let stuff go bankrupt in 2010, keeping zombies open. So now we have 40% of Russell 2000 are basically, really dead, walking dead. It's going to be 50 or 60%. They're just making it bigger. So again, they have an election to win. What if? New sheriff in town, right? Trump is very inflationary. And this is not a political, I like one over the other. They're both bad. But Trump is very inflationary. What if RFK comes in and disrupts a two-party system? 50% of new voters that are registering are voting independent. They actually can't vote independent in some states. It's called unenrolled. So they're not associating with Democrat or Republican. What if they go for RFK? So if we do get some type of full stop in this fiscal spending and some type of restraint, that's the only time bonds are actually going to bounce and stick the landing. But everything else will suffer.
Okay, so you said, Trump, I think, was clearly inflationary. I've been arguing about this with people for a long time. He spent money. By the way, I say spent like a drunken sailor like 5 times a day. There's got to be another good one. We're writers. We got to be able to come up with a good one. By the end of the show, I want to be able to do that. But anyway, okay. I have argued.
I got one I want to try out on you guys toward the end of the show.
Put it in like elegantly, like, yeah, right in the middle of a conversation.
You got it.
So Trump was inflation before. He spent money like a drunken sailor when he didn't need to and racked up the debt long before all the nonsense happened with the lockdowns. Do you think he genuinely is that dumb to behave the same way?
Yeah.
Like
that's a yes is a complete sentence. Yes is a complete sentence.
Okay, good.
The end.
So
next.
That's okay. So I'm hoping you're wrong, but I have nothing to base that on. I'm hoping you're wrong though. So back to the banks real quick. But you said your bank analyst is. I think that the commercial real estate lobby, the commercial real estate people, I think they're in Jay Powell's ear going, there's bad things on the horizon. And I think that that's one of the reasons he continues to talk about eases despite the fact that the market doesn't seem to dictate that. Or is it just a political thing? What are your thoughts on that?
Oh, it's a money thing. I mean, the private equity and the regional banks that are exposed to CRE is major. So the longer they can push out the pain, number one, the more likely that some of them can in fact repair, right? The other side is that it's also great pennies on the dollar for the Carlyle groups and the Blackstones of the world who are going in and getting these assets wicked cheap. So right now they're in this kind of bargaining phase of the post-apocalyptic phase of COVID lockdown and work from home, where the Treasury and Fed and White House all came together and backstopped and said, okay, all these unrealized Treasury losses, we're going to make them at par, right? And, don't worry about it. Don't worry about it.
No, when it's my money, when it's your money, they're very generous. We'll buy them at par, despite the fact they're not worth par. That's Samantha's money. People, that's your money. But anyway.
And 150 billion in student loans canceled and. So they are printing money so they can spend it so they don't ever plan to repay it. And that's why treasuries are a bad bet. This is absolutely a collateral that should be treated with care and, integrity. So they've lost that. And I actually just, I don't look 5 years out because I believe in the kind of ingenuity of Americans. I also believe that we will have to do more for ourselves, right? And this will create some opportunities. Our trade balance will start to reverse, which will also be healthy slowly. De-dollarization, I don't think it's going to be the end of, our, it might be the end of our quote unquote reign, but I don't think it's going to be bad for us economically unless they keep doing this incredibly irresponsible spending and literally as if they will never have to repay it. They have that mindset. They never have to repay it.
So, all right, I normally don't do this, but this show's live right now. So we can talk about what happened this morning with the CPI numbers and the situation of the Fed. I saw Larry Summers today say that basically the market might have to get used to the idea that the next move might be a hike from the Fed. Now, it sounds to me like you think, similar to the way Jimmy and I do, that the Fed is political. I'm not putting the words in. So, yeah. And Steph Pomboy today called them the de facto arm of the Treasury, that they essentially will be bailing the Treasury out as long as they can. What are your thoughts on that? By the way, on top of that discussion, they were saying that the Fed is much more likely to stop QT and restart QE rather than cut rates as a means of yield curve control. Do you have thoughts on any of that?
A few. First, that's the definition of, fiscal dominance over monetary dominance. So we don't actually have a lot of experience with that in the U.S. Talk to folks that are in Argentina and emerging markets. They have a lot of experience where the devaluation of their currency is what is sending their stocks into the stratosphere, right? Et cetera. So we really don't, lots of bulls are very excited about this and the options that they can, lever to make money off it, but it's so bullish, it's bearish. So the fact that we can see a lot of politicizing of both the Treasury now controls the Fed. I actually think the Fed is the tail, the flea on the tail of the dog. So Congress has the spending, Treasury has to figure out that whole money situation, and then Fed is just basically answering right now to Treasury. So there's nothing independent about this line at all. It's completely interdependent, and that is very dangerous long term. So I honestly hope we do have an interruption come election, just to kind of create this awareness that it's we've done this to ourselves. let's fix this. But I don't know if that's going to happen now or 4 years later.
So the point Samantha's making, which I tweet about this every time, particularly every time there's an inflation data come out. We did it to ourselves, but we continually do this to ourselves. We are
Correct.
doing it today to ourselves. We are, what is it, like $6 billion a day of new debt. This is insane. Okay, so the Federal Reserve has been around for 111 years now, 1913. Would we be better off with no Fed at all, or should they just be rules based?
So it's really funny. So I am not a history buff. I am, like I said, I am blessed with one of my teammates is a classical economics super brain. And he's like, when we had the most explosive economic growth over 100 years ago during that Industrial Revolution, there was no Fed, right? Mm-hmm. So they came in and mucked it up. But this is someone else's kind of torch to bear of whether we should have, it's more philosophical or maybe religious, I don't even know, of whether we should have a Fed or if Bitcoin will fix that. I have, solid opinions about that too. But the point is, we have what we have. So all I'm trying to do is look at how do we get from here to the end of the year, right? Client money, how to navigate when it's bullish, when it's questionable, when it's risk off. And we haven't even talked about what the heck is going on with the Middle East. But bonds are not happy. And the dollar is a release valve. Gold and silver are clearly indicating, the stress abroad with this, continued hoarding, fast action here in precious and industrial metals. Soft commodities are also hot fire flames. So yeah, they're kind of, the Fed is gaslighting us. We know this. Biden and the Treasury, they're all gaslighting us. So that's why it really has to come to a full stop in order for bonds to be bid, in my opinion.
So before, can we talk about crude oil a bit?
Oh my God, please.
Okay, good. Crude oil up 25% since December, up 8% just since March 27th. What is that telling us? Is it a dollar hedge trade? Is it a global reflation trade? Is it a little bit of both?
I think there's a lot of risk premium from the geopolitical risk in there. I don't know how much of it is in there, and some really bad actors, the SPR, this whole thing is questionable. But OPEC is actually gaining an upper hand again. I didn't know that Citadel, the largest, hedge fund, most profitable hedge fund in the world, I should say, is now the largest trader of commodities. And they came out a few days ago, and I tweeted this. So if you saw this, and they said OPEC actually is now back in control. So, whatever. But I think that this is truthfully a short kind of long. In other words, it's an intermediate long because of the reflation trade. It's a beautiful hedge on inflation, energy, metals and mining, soft commodities, right? It's been a beautiful actor this year because they already smelled it. So now you move into oil, there's going to be at some point an escalation. People are expecting that. And then it gets tapped down hard. The US comes in with some article about Venezuela oil coming online, right? Then you see oil soften or some type of, again, forced EPA rule. something will come in. Well, they will absolutely try and suppress the price of oil before the election because they can't have that go too high either. Can't have oil, dollar, or the 10-year, which makes the world go around, go too high. They will do something. That's my baseline bet. That's the motivation they have to follow to get their man elected.
This is amazing because this takes me back to this whole Fed credibility thing. I swear for 10 years, I've been telling people when they talk about the Fed cares about their credibility, like it doesn't seem that way to me. I mean, they're wrong about so many things that like they want to keep their credibility. They don't have any. Mm-hmm. But when I look at something like gold, so I obviously agree that basically when our policy changed to anti-fossil fuel, and this is not political either, this is policy. That is what our policy is. It's anti-fossil fuels. Mm-hmm. We lost our status as the marginal producer in the US. And now everyone's screaming from the rooftops that we're at record production. But I wrote a Substack about this on mine and Jimmy's Substack, that it takes best case scenario from lease to production, 18 months for a shale well. Normally it's more like 2.5, 3 years. From the time that they actually think they'll be allowed to drill for fossil fuels. It takes about 2.5, 3 years to actually get oil out of the ground. So first of all, I want to tell you, not that this matters to you, but you're completely right about OPEC having the kind of power that they have right now. They have more power almost at any time except in the 70s right now. Mm-hmm. And we saw that when you talk about how much risk premium. Sorry, we're supposed to be interviewing you.
No, I want to hear this.
There's so much risk. There was about $6 of risk premium based on what Iran might do in retaliation for the attack on their consulate in Damascus, because they have the ability to close the Strait of Hormuz, which is Hormuz. I can never say that right, but which is basically 60% of OPEC's exports go through there. Now they might allow some through, but it would really, really hurt crude oil. I got long about March 22nd crude oil. I lightened up about 4 or 5 days ago. It's 5 days ago. And I'm about to get in again because the geopolitics, the supply chain is healed, in my view. This is what I want your opinion on. The supply chain, the damage we saw during COVID was healed, but I look at it like somebody who was 50 pounds overweight that became 100 pounds overweight and now is back to 50 pounds overweight. And I think the bad actors have seen how bad we can be crippled by supply chain problems. And I think they're more likely to act on that. Am I a conspiracy guy?
No, but there's a bull and a bear case for everything, right? So I made a call in March of 2021 that it was an if then. If crude got above 65, it would double within a year. And it was very much based on interest rates moving higher and oil as an inflation hedge. That happened. It shocked the hell out of me. So now it comes down, right, from 130. We've gone sideways for a while, and now we're kind of percolating back up, and folks are getting worried. I'm actually very, again, blessed. I've got a trading desk of subject matter experts. So I've got an oil trader who does the physical and consults with companies that actually manage the physical, and his father was a trader before him. So, oil trader before him. So basically, he is really laser focused on supply and demand. This supply disruption is a short-term bump, and risk premium also all part of that. But ultimately, there really hasn't been the interest in this space, again, because Biden has anti-fossil fuel policies, and demand has not been as robust. So then I kind of go and I look at another one of my contributors who's very focused on China, and he's like, you've no idea. I mean, the EV space has, market share is now 40%. They are less dependent on oil now. That transition where they were the largest marginal buyer in the world of commodities has transitioned to, consumption. They want their own people to stay and buy the cars that they produce in country that are EV based. And that is going to also help them wean from this dependency on oil, which is priced in dollars. So now they're really buying EV cars in yuan, not buying oil in dollars. It's very good for China. So I look at that kind of, okay, that's why demand is also falling. And now China's coming in backdoor via Mexico, EV. So there are operational efficiencies in the oil patch. There are, supply disruptions, all of the shipping drama that's happening from Panama, to the Middle East. But ultimately, it's a demand story. It really, really is a demand story. And right now, it actually has a huge headwind as both the U.S. administration and the Chinese manufacturing base is eating our lunch as it relates to car manufacturing. I mean, Chinese exports of cars are much bigger than Germany now, and it's coming. It's coming. So I do think that this is actually a headwind or at least a ballast for the deficits that are in the supply side, which is your argument with oil. Does that make sense?
It does. Yeah.
Which good. But you mentioned EVs. A year and a half ago, I gave a speech at the New Orleans Investment Conference, and it was about, and sometimes I do a 5-year lookout. I mostly do what you do as well, but it was copper, and it was about why. And I was right, but for a year, it appeared that I was wrong, and that traded so sideways. China was on the brink. We didn't know what their economy was doing. The EV world here, the appetite seemed to change. But the way you're saying now with China and with Mexico, you think the EV thing is here, it's real. Does that make copper a good place to be currently?
So copper, first of all, on the EV thing, yes, I think this is one way that China is becoming obviously not only a manufacturing force in cars, but also less dependent on oil. We are still the marginal, provider of oil in the world and pricing with OPEC. So it's definitely moving away from that. Copper is one of those kind of deficits, right? Supply deficits, uranium, copper. There are so many that are fabulous, just fabulous manifestations of the inflation trade, and also that we still have demand, whether it's EV or just manufacturing that we have to reshore. It's a fabulous play. And I say uranium because, again, I was really blessed that I had a fabulous client who was very involved in uranium early in 2020. So that was immediately in my trend long portfolio, like November, December of 2020, going long CCJ and URA, because his whole focus was on, he's a co-founder of the Uranium newsletter. So I listen to people. So I listen to people who have really good arguments, and then I track it. So I think copper is one of those where they're not going to even invest in new mines unless the price of copper can rise up to $6 or something. So there's definitely an incentive with miners right now to stay positioned, even though, and I mean miners, gold, silver, copper, maybe even palladium and platinum, but they're not really my, wheelhouse, because the investor sentiment is so low. And for good reason. They have destroyed investor sentiment, investor returns. But now I think we have a very different backdrop. They're not only great hedges on inflation, they're in supply deficit. Everybody's looking to buy them as a proxy. Oil can wreck us if it gets too high, but these other commodities we can manage, right? It's very much an institutional trade. But I think that's really a great long-term play. I'm very bullish copper, but I'm also bullish uranium. But this is a multi-year thing. We're not gonna,
So when you just said crude can wreck us, you mean there's a level we get to, there's demand destruction, and it can rectify itself. But whereas copper, that level is clearly higher. Okay, I want to make sure.
Yes, exactly. That's my point.
I just want to make sure. Yeah.
But are you bullish multi-year? Because I think it's a fabulous multi-year trade.
Great. I am long up to about my teeth.
Exactly. So that's what I mean by concentration risk in things that aren't going away as long as they're in demand, not just a supply deficit argument. So I'm very bullish. A number of miners that I think are not because gold and silver is, getting all excited. In fact, the miners that are least efficient are the ones that have the highest beta. I'm talking about gold and silver miners. They have the highest beta to spiking higher gold and silver. So, because it hits their margins, Sure. Yes. Yeah. So I did a whole big study for clients over the past month because we've been on this early, identifying the tier 1, the tier 2, just the, they still have troubles, but they'll still move higher as gold and silver moves higher. So I think copper is definitely in that category of it's done going down.
So in terms of, you mentioned earlier in the show that you were starting to look at maybe some shorts. Are you comfortable saying where? Okay, so where are you looking at shorts, and where are you thinking, okay, I'm not going to short this, but I'm going to look for a place to put on a longer term long? You can sectors, names, whatever you want to do.
Oh, no, that's easy because I have all that. So I have a trend long portfolio, and it's just that. It's just long because clients, some just want to set it and forget it, right? And a lot of those plays are going to be more value. There's a few definitely medical distribution, medical device, some one tech. But the point is, most of them are not earnings plays, like NVIDIA was an earnings darling in play. They are tied to assets. So I'm, heavy into things over paper. And then I have a swing portfolio. And by the way, trend is multi-month. It can go for years. It just so happened that the uranium play worked. Well, why take it off, right? But swings are very, very different. They are multi-week. They can turn into months. Amazon above 146 is now 186. Okay, fine, it's still working. But I'm not concentrated and committed that this is going, I know it has a big moat, but that's not my thing. I'm going to then look for the sectors that are way overvalued and absolutely should come down, like an Abercrombie and Fitch, ANF. So this is a high conviction short. Set it up a few weeks ago. Clients know this because if you look at the returns from May of 2023, into most recent high, they were up 500%. If you combine NVIDIA and Bitcoin, they don't make up 400% combined. So it's ridiculous, and then as soon as I was long Crocs and sold that because early last week, because I could see what was happening with retail. PVH, which is an apparel manufacturer, waterfall cascade, Lululemon, waterfall cascade, Ulta, waterfall cascade. So the retail is now kind of getting forced off a cliff. And when that happens, that I know we're going to have some turbulence come in with small caps as well. And sure enough, it happened. So I definitely think there are some names that are just way overvalued, and that's an example.
Okay, I have a quick one because when I was on with Larry Kudlow and Pete Nigerian on Saturday, and the radio show we talked for a long time, and Pete was talking about the big banks, and I was trying to make a case for the big banks in my head too. And the only thing I could think of is if we're talking about long end rates going higher, they might like a steeper yield curve. But then I thought perhaps the trade is, and I do not have this on, I'm considering, is short the mid-range banks, the ones that are going to crack and crumble when the commercial real estate happens. But the 10 biggest banks have already we've been told by Janet Yellen. She looked us in the face and said, oh no, we'll nationalize them. We'll do whatever we have to do. If you're screwed, if you're not systemically important. So is an interesting trade to you, short the mid-range banks, long the big banks? Has that played out already? Thoughts?
I think the banks have played out already. This is, of course, going to be, survival of the fittest and largest, and, there will be issues, but I'm not really in the banking space as it relates to which ones are most weak fundamentally. I rely on someone else who really, really is in the weeds for that. And KRE, you can already tell, just from the charts. Oh my God, it's terrible. So there's nothing good about that. When regionals are suffering still, and then you just have this concentration risk in the JP Morgans. Well, of course, JP Morgan's doing well. Why wouldn't they? So it's not, though, indicative of the health of the whole sector. And I look at tech the same way. I mean, when I look at NASDAQ Composite versus NASDAQ 100 versus the MAG 7, and I have a ratio for all of these, there's no question that MAG 7, even with Tesla and Apple falling, from the tree, so to speak, they're still there, strong. They have not given sway, maybe during earnings. But the stuff underneath, the mid-cap tech, oh my God, it's a mess. There's no breadth expansion in tech. And I actually thought in January, February, that this would be, and there could still be a chance, this widening out where IPO plays started to come up off the ground again. So that was my baseline bet, that watch them, we're going to have select stocks come back up. And it worked for a few, like Carvana, for example, that, really was a nice play, but that's also short covering. So it's not really a sector strength. The point is, I'm not seeing any sector strength in tech underneath the Mag 7. And that's a worry.
So Carvana is so funny. Like literally, I'm having a hard time. And I know understood a short covering trade, but a Pez dispenser to sell cars, that just seems so asinine to me. I cannot, there's in no way can I get behind being long. I can get behind, squeezing out some shorts.
That's it. That.
Yeah,
I actually had Jim Chanos, because I did a video on Carvana as a short squeeze. And he's like, you think NVIDIA is rigged? Have you looked at Carvana's fundamentals? And I'm like, yep. I also know Apollo did a lot of debt offering. I know the CEO and his father came in, to insider buy just to stem, the descent and the exodus. So there's something there, and the shorts are beautiful, right? So yes, it's a short covering play. It's not because it's going to be, recovered in full, unless we get the monkey business that we continue to have, right? Where they just keep pummeling us with trillions and trillions, and then junk rises. It's just all there is to it. But I think it's a diminishing rate of return now with yields this high. It's too hard for them, and I think the gig is getting harder and harder for them.
One of the reasons I want yields to even go higher still is because I'm so sick of moronic things rallying that we all understand. Excess liquidity trade, and other people are like, "Did you buy GameStop?" I'm like, I can't think of anything to say that. No, I didn't buy GameStop. I didn't buy any of those other stupid stocks.
But do you understand the psychology of that? It's actually very, very sad. And I've talked with GameStop and AMC holders, right? Like mother. Why are you doing this? Because, Wall Street is evil and they have control, and we need to take back control. So we're going to join this mob, and we're going to fight them, right? And so what happened last year? Citadel had their biggest profit gain in history. Oh, sorry, in 2021, in history, right? This is how you become the most profitable hedge fund. You take money from, those who don't know how to protect it. Yeah. It's sad, but it's their form of defiance.
Mm-hmm. No, Bobby and I do a lot of work with retail traders, and different brokerage houses, bring us in to do that. And always it's like, you live to fight another day. If bulls can make money, bears can make money, pigs get slaughtered. All these people who chase performance and do it in such an idiotic way. We're trying to talk these people off that ledge that they're about to jump off. And we have mixed results, you'd say, Bobby, wouldn't you?
Yeah. I mean, I try to tell people all the time that if you actually pay attention to what we're trying to tell you, there could be no Bernie Madoffs. Yeah. Because you would raise your eyebrow and say, wait a minute, 1% every month, forever, something's wrong. Right? You think something's wrong. Yeah. Which, it's interesting. Another one I use, Samantha, is I tell people, when you leave a restaurant, you take your to-go bag. You don't walk around to all the other tables and grab all of their to-go bags. Like, just get your food and be satisfied with your food. What's going on in the rest of the market? It's like FOMO, unless it's part of your process where you say, okay, what's the biggest mover today? That's what I'm going to react to. I tell people, don't even look at it. Just look at what you've been focused on and see if you have a signal or you don't have a signal. Which brings me to Bitcoin.
Oh my God, I was going to say, then let's talk about Bitcoin.
Yeah, because you said you have a strong opinion on it. I do as well. Jim does as well. And if you look at it from about March 12th, it's really done not much since about March 12th. So I don't want to ask where you're positioned. It's not important to me. What's your thoughts on it entirely?
Oh, this is something that I have actually been watching from the sidelines, from a purely just a point of fascination, a point of case study, a point of technical analysis only, because I could not drink the Kool-Aid. I cannot join a religion without, I don't believe in cults. I don't think it's really healthy for, returns, but I will tell you, I understand it better a little bit. Even if I am a detractor, I think it is fabulous rogue money for those in need and those in greed. It has an absolute use case for those who really need to get their money out of a country fast, like Ukraine or somewhere in Africa. But as it relates to a means of production, it's going to be used in the exchange of actually developing, producing goods and services, not so much. As it relates to their whole religion about holding on to Bitcoin because we have debasement of America. They're not just talking about, devaluation of the dollar over time, which we can see in a chart ourselves for many decades. They're talking about debasement of America. You don't wish that on anybody. So that pisses me off, actually. So then you've got, actually the extent at which you have transactions in Bitcoin. Okay, maybe a few 10 billion, 20 billion a day versus 7 trillion in dollars. Dollars, again, they are going to diminish in time, which is as far as use. We got 85% of contracts are based in them, 7 trillion in daily, transactions. But for what I can see, Bitcoin is very much this means of exchange, very great for those in need and those in greed. I mean, I've got Craig, right? Shapiro, my macro advisor edge manager, who has been in since 2014. He's a rich man because he traded Bitcoin. He understands from the macro standpoint why they justify it as a proxy for treasuries. And so I understand why someone is a bull in Bitcoin. I don't think it's valued at 70,000 or 60,000. I think it's probably 6,000. This is just my belief that it's a mania. And if you trade it to make money, fabulous. But the disingenuous bullying type of tactics that they use for those who question it or aren't in it, or the hero worshiping of a Michael Saylor. Oh my God, be careful who you worship, people. This whole thing is a beanie baby holding a tulip.
So, okay, you said something there that I really want to touch on. Two things, actually.
Keep an eye on the clock too, Bobby. They're going to kick us out soon, but anyway, go on.
Yeah. So you said that as a means of production, no. Did you mean A, it's not there yet, or B, it can't get there? And then the second part, so then you can just close out the show with the answer. You talked about debasement of the currency. The guy who taught me how to analyze, chief market strategist, that I was an assistant market strategist under 30 years ago, texted me this morning talking about the debasement of the currency since about 2017. It's been about 8%. And if you add 4% inflation to that, you need 12% return on your investments to break even every year. Is that what you meant by as a protector of the debasement versus the debasement of America? Go ahead.
No, I meant as a means of you're going to be exchanging it for wheat and corn and steel to put into productive use as an actual unit of value that is exchanged versus just Bitcoiner to Bitcoiner.
Gotcha.
Okay. I'll add that for me, my entire thesis on Bitcoin was BlackRock's getting into it. So
oh my God, brilliant. They're printing money. Oh, for my God, from the fees. And now you've got even the undersecretary of the Treasury today out saying, you know what, we're cracking down on money laundering, and Bitcoin crypto is a big culprit in this regard. So, there's always this risk that they're going to take it away. But what there isn't is anytime soon that they're going to force it on us. In other words, we're never going to have to pay our taxes. They're never going to allow it to be used to pay our taxes or, our property, our medical bills. The point is, this to me is a fabulous rogue money. And I hope it survives and I hope it thrives. But the mob is too much. And I believe very, very firmly that a gang is only good when they're together. You take one-on-one those individuals in that gang and they will melt. Oh my God, yes. So I don't mind. I'm like, bring it. I
love it. This has been a gas, by the way. I can't believe it's been to this long that we've had you on a show before, and I'm sorry for that. Tell the people where to find you. Most of them know already, but yeah.
Okay. Thank you so much. LaDucTrading.com, LADUC. I'm also at Samantha LaDuc, both on X, the old Twitter, but also Substack. So I have just kind of launched a Substack product this year, little taste of my market thoughts.
I've read it.
And my live trading room too. So
It's fantastic. That's awesome. Thank you so much. You've been just a fabulous guest. And thank you, people, for joining us. This has been Tradier's The Trader's Edge. I'm Jim Uriel. That's Bob Iacchino. Thanks again. Remember what we're trying to do here. We are trying to create platforms that are not captured by stupid sponsorship money that affect the way people say things. These are just our opinions, may be wrong, but at least they're our honest opinions. Thank you guys for joining us.
Thank you so much.